Hi, my name is Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's supply and demand, Forex, gold, and S&P fundamental and technical analysis for the week ahead, starting the 23rd of February. Hope you all had a great trading week, and if you like the videos I provide every weekend, please don't forget to like, subscribe, and share across your social media platforms. So, getting into the week ahead, next week, investors will focus on speeches by several Federal Reserve officials in the United States, alongside key economic data, including personal income and spending, PCE price indices, durable goods orders, the second estimate of Q4 GDP growth, and CB consumer sentiment. Globally, inflation figures will be released for Germany and Australia. GDP growth rates are expected from Switzerland and Canada. Meanwhile, Germany will publish its LFO Business Climate Index, GfK consumer confidence, and retail sales figures. So, a few things going on. Also, as well, we got the German elections as well, which I'll get into a bit later. So, starting off as we typically do on the dollar index, and this is the equally weighted dollar index. And yeah, over the past several weeks, maybe about a month or so, we've had a bit of a decline. So since the beginning of February, really, when the tariffs were supposed to be implemented, a lot of fear, uncertainty, doubt around what was going to happen around the tariffs, and then Donald Trump gave an extension to Canada and Mexico. The dollar has kind of sold off, and it's, again, as I said, to do with the tariffs and the expectation around what that's going to look like. And so at the moment, the market are kind of pricing out any aggressive tariffs that may affect GDP and global GDPs, so economies across the globe. So, but when it comes to the US dollar, from a fundamental perspective, I think the dollar is still more of a buy, from a monetary policy interest rate perspective. But really, the narrative at the moment is being driven by the expectation of and the effect of what tariffs will have and trade deals, right? So it says here, currency traders are underpricing at the moment the risk of fresh tariffs from the Trump administration, bolstering the appeal of the dollar and the outlook for further gains, according to strategists at Goldman Sachs Group. Ultimately, not all tariffs are equal when it comes to FX, wrote Goldman's Karen Reichgott Fishman and Lexi Cantor in a Thursday note. But given the unwind of premium in key crosses in recent weeks, we once again think tariff risk looks underpriced, making long dollar exposure now look even more attractive. And it says here that Goldman Sachs team acknowledged that being long dollars might be challenging in this environment, but added that bearish bets against the euro and Canadian dollar are relatively inexpensive hedges against tariff risks. Reciprocal tariffs, rather than those against critical imports, represent the greatest upside risk for the greenback, they said. So we have had a bit of a decline in the speculative dollar bulls pulling back in recent weeks. So asset managers, institutionals, are pulling back on the dollar, because the dollar was really kind of a bit of a crowded trade, right? So probably some profit taking going on, as well as the tariff narrative maybe playing out not as aggressively as the market had kind of priced in. But ultimately, when you look at where the trend is from a price trend, and really you should never make decisions based on whether price is trending or not. It's really about whether it's all about the fundamentals for me, and risk sentiment. But ultimately, a lot of traders would be looking at the recent price action and saying, maybe over the past month or so, and looking at, this is the past month's price action, and says, think that the dollar is really bearish. But when you look at it over the last 6 months, in fact, the trend is continuing to the upside. But ultimately, for me, the dollar is still a buy. It's difficult to trade risk sentiment, simply because one day Donald Trump could come out and be quite hawkish or aggressive with tariffs, and then one day you come out and be quite dovish. But underlying my baseline is really about monetary policy. And so once the dust settles when it comes to risk, ultimately, right now, the data shows that the dollar for me is still a buy. So we're just getting cheaper and cheaper prices to look for dollar buys. Hopefully, of course, the data supports that. And we've got inflation data this week. And if that does support more holds for the Federal Reserve, I think the dollar should rally. Moving on to the dollar yen, and the dollar yen. Again, we've seen really the yen strengthen over the past day, or actually even more than that, because really two things, of course: risk off sentiment coming into the market, as well as inflation data for the yen, and Japan really coming in higher than expected, which is pushing forward or bringing closer the expectation that the Bank of Japan may actually raise rates sooner than expected. So Japan's inflation accelerated more than expected on higher food prices, rising at the fastest pace since the middle of 2023, and keeping the Bank of Japan on track to raise its benchmark interest rate further. The report reaffirms Japan's overall inflation as the highest among a group of 7 nations, underscoring Bank of Japan's board members' recent comments about the need to watch upside risks. While Governor Kazuo Ueda has overseen 3 rate hikes in the space of a year, the continued strength of inflation could encourage speculation that the next hike will come sooner than expected. Economists surveyed last month saw the next increase in borrowing costs coming around July. So we've got a mixture for the yen in terms of bullish news. Rising inflation means that the bank are likely to hike rates, and in this case, hike rates a lot sooner than expected, as well as some risk off sentiment. So money going into the yen at the moment. So yeah, we've got a nice supply zone there, as well as really, I guess, the kind of start of another supply zone there as well. So not really interested in trading this pair, but if you are, then if you're looking for buy trades, now is a decent time, or maybe a bit of a pullback into a fresher area of demand. Or if you're looking for a short trade and buying the yen against dollar, then that is really the trade or the area you want to start to look towards. To me, you've got 2 decent currencies. One currency, the US, who are looking to hold rates, and the Bank of Japan, who are looking to hike rates. For me, the divergence really isn't there too much for me to be interested in this pair. So, but if you are technically, then those are really the areas you're looking for. Dollar Swiss, I am very interested in, and I'm actually in this trade. I'll go over the this trade a bit later on the new trades towards the end of the video. But for me, the dollar Swiss should be a long from a monetary policy perspective. You've got, as I said, a central bank that is looking to hold rates, whereas the Swiss franc are very dovish on their currency, in terms of they think it's expensive. And so what they're actively trying to do is actually make the currency a lot cheaper. So there's rumors that they are looking to intervene in their currency. They want it cheaper. They want to cut rates possibly down to 0 or close to 0. So ultimately, I think the dollar Swiss should be more of a buy. Now, in the short term, with risk off sentiment, both currencies are considered risk off currencies. Maybe the Swiss franc a little bit more so than the dollar, but ultimately, even if prices pull back a little bit more, I'm still going to be looking for buy trades. So if it pulls back down to, and I get stopped out, for example, on my trade, then I'll look for a buy trade here, because I think the upside potential on this pair. We should want to revisit the highs, I think, or at least close to the highs at some point this year. So that's where I am with the dollar Swiss. But if you are looking for short trades, if you want to go against my analysis, which is always more than fine, then you're looking at a trade, a pullback to a supply zone before looking at going short. So either there, or you're looking at a short trade right here. If you feel that the Swiss franc is more of a buy than the dollar. Dollar CAD, and again, I think out of the two, I think that the US dollar should have really the edge. Again, the Canadian dollar is really going to be driven by, and I think obviously most markets now are driven by the tariff narrative now, because the Canadian dollar and Canada in general is pretty much neighbors to the US and the United States. They're going to be affected the most. Now they've had a bit of an extension, but as we get closer to the end of February, that extension starts to come to a close, right? And so a deal needs to be done. So if a deal isn't done, then Canada pretty much just on the start to get a bit more aggressive with their negotiation tactics, then ultimately you'll see more upside, I think. If you are looking for short trades on this pair and looking to short the US dollar, then those are really your two options. But I think the path of these resistance should still continue to be more to the upside. Pound dollar. So the pound dollar, the pound has actually had some decent news this week. If we go to the UK channel, and it says here, traders trim bets on further UK interest rate cuts from the Bank of England this year in the wake of a surprise jump in UK inflation, and now see fewer than 2 more reductions through December. Money markets are pricing in just 49 basis points of easing by the year end, at least since January, since January the 31st, after the central bank cut rates earlier this month. Data on Wednesday showed that consumer prices rose at a 10-month high in January, complicating the Bank of England's rate outlook as policymakers look to support growth without reigniting inflation. And that is the key, right? That's the trick, because that's really about trying to avoid stagflation. So yeah, we're seeing some decent data coming out of the UK, but as I said, there's still kind of stagflation fears. And stagflation, in case you're new or don't necessarily know what stagflation is when you have rising inflation but you have a contracting economy. And so it's a bit of a conundrum for the central bank, and so yeah, they are very worried about stagflation, because ultimately, if inflation keeps rising, then they have to hike rates. But by hiking rates, the effect of hiking rates is that it puts pressure on businesses, right? Because of borrowing and lending. If you start hiking interest rates and you're raising the borrowing and lending for businesses and consumers, and things become a bit more expensive, mortgage owners have to pay more on their mortgages. If you're on a variable, then ultimately that hurts the economy. So what do you do as a central bank? Do you hike rates to try to get inflation down, which I guess they're mandated to do, but at the same time hurt the economy? Or do you hold, maybe try to cut rates, support the economy, but if you cut rates, that kind of boosts inflation? So again, the conundrum. So it says here, the UK businesses stepped up the pace of job cuts in February as firms faced a stagflationary backdrop, and new work dried up, according to a closely watched survey. So the S&P Global Purchasing Managers Index was little changed at 50.5 versus 50.6 in January, just above the 50 threshold, separating growth and contraction. Economists had expected no change. The survey suggests that job cuts and price pressures in the wake of a hike in employment costs at Labour's first budget intensified. The fall of private sector headcount was the sharpest since November 2020 and the worst since the financial crisis when excluding the pandemic. It marks a fourth straight month since the budget when the UK PMI has pointed to a stagnating economy despite Labour's efforts to turbocharge growth. So businesses are bracing for an upcoming £26 billion hike in payroll taxes and other sharp rises in the minimum wage, which threaten to hobble the government's growth agenda. And however, the PMI survey contrasts with other indicators that show the jobs market stabilized and even improved in early 2025. So at the moment, I think the pound in the short term could be seen as either a buy or a sell. If you're looking for a buy, then I wouldn't necessarily buy it against the dollar. There are definitely weaker currencies to buy it against. So, but if you're interested in buying this pair, you could go either way, buy or sell. So you can look for a pullback into a demand zone, or you can look for prices to move up slightly a bit more into that supply zone, and then look for a sell trade. But I'm not really interested in this pair. But if you are interested in joining Trading 180 and have been waiting to do so for a while, then enrollment opens on the 25th of February. It was the 24th, but I've had to delay it by a day. So enrollment opens on the 25th of February. So if you have been waiting to join the community, then yeah, 25th is when you can join. I'll be open for, again, a short amount of time, maybe about a week or so, and then after that I'll be closed, as I like to keep my groups quite focused. Also as well, among the many things that you'll get access to, one of them is the members trading videos area, which has a lot of members videos which I don't necessarily put out on YouTube. And so for the members who are watching this YouTube video, just to let you know that we have the members area video here, which is over an hour's long in terms of the analysis, as well as tons and tons of members videos, hundreds if not thousands of videos, years of videos over in the members area. So if you do want to join, 25th of February is the date. So getting back to the analysis and looking at the pound yen. So the pound yen, was saying obviously last week that you could look for some short trades here, which actually has worked out quite nicely. The yen has gone from strength to strength. Not necessarily a pair I'm interested in. I do like the yen as a buy, but not necessarily against the pound. In fact, what I'll do is I think this can stretch up all the way up to here in terms of a supply zone. If you are looking for buy trades, now it's probably a decent buy. Technically, if you're looking for a sell, then you're looking for a pullback at least up to this 192 area before looking at short trades. But I think the yen is definitely a buy, but I think there are weaker pairs to trade it against than the pound. Looking at the euro, and this is the euro index, and the euro index again is like the dollar index, equally weighted against the dollar, pound, yen, CAD, Australian dollar, Swiss franc, and New Zealand dollar. And over the past week, it has just got a lot weaker right now. Several things going on with the euro. Of course, the main focus in the short term is going to be the German vote. And it says here markets are complacent on the euro as German vote raises parity risk. So options market shows majority of euro bets favor more gains. Surprise outcome could push euro below 103, Pepperstone says. And it says here euro traders risk getting too comfortable as the clock ticks down to German elections this weekend. There's an unusual calm in the derivatives market. The majority of euro options expiring the day after Sunday's vote tilt in favor of more gains, and bearish sentiment on the common currency has faded. Stock markets are also pricing a benign outcome, with Germany's benchmark DAX gauge at a record high. That positioning threatens to flip painfully if the centre-right CDU CSU alliance, which has been leading polls, struggles to form a coalition. Such an outcome would likely drive the euro towards parity with the dollar as uncertainty and political horse trading with smaller parties ensues. Everyone seems to be assuming that it will be a non-event, says Michael Brown, senior research strategist at Pepperstone Limited. That sort of complacency could lead to more of a market jolt. So markets getting complacent or are complacent about the elections, which is surprising to be fair, but I do think that the euro is still more of a sell from a fundamental perspective. So when we go to the euro channel as well, it says here that business activity in the euro hardly grew again in February, reinforcing fears that the bloc remains mired in stagnation. The somewhat milder recession in the manufacturing sector is only being overcompensated for by the barely noticeable growth in the services sector. Cyrus de la Rubia, an economist at Hamburg Commercial Bank, said Friday in a statement, adding that the figures don't point to a recovery. Investors added to bets on European Central Bank interest rate reductions. Money markets are now pricing 78 basis points of easing this year compared to with 74 basis points on Thursday. So yeah, it looks like the euro is cutting the most. When we look at the rate cuts by the year end, we see here that the Fed are the bank that are probably cutting the least. Now you might look at the Swiss National Bank and say, well, they're cutting the least, but also they are intervening in their currency, or lightly intervening in their currency to make it cheaper. Plus they haven't got too much room in terms of cuts when they get to zero. So there is some nuance there, but in terms of even if you're looking at what the next move for the central bank is going to be, there's a 98% probability of no change for the Fed, and there is a 73% chance of a rate cut for the Swiss National Bank. But going back to the ECB, it looks like they are the central bank that are looking to cut the most at the moment. So 72 basis points worth of cuts. And remember, the cuts are designed to weaken the currency. It doesn't mean that they always will, but that's the effect that cuts should have on a currency. So, and there's a 95% probability of a rate cut at the upcoming meeting. So, looking at the euro, for me, fundamentally and risk sentiment wise, there's really no reason to look to buy the euro. Of course, if the government do form a coalition that is favorable for the euro, then you may see the euro start to rally, of course. But ultimately, if you were looking for short trades, then a rally for the euro should be really a shorting opportunity. But of course, you could take advantage of any rallies in the euro on Monday if the government do form a coalition and a favorable coalition for Germany, which would be favorable for the euro. But if I'm looking at the euro dollar, I'm not in this trade, although I'm interested in going short. For me, the setup here is more to do with a stop hunt, a price. If prices go up into that supply zone and look for a short here, or if prices go up and then close back inside that area, then I'm looking for a what's known as a stop hunt trade, and that's what I'll be looking for. I'm still bullish on the dollar and bearish on the euro. So bearish on the euro dollar. So I do think that prices, they're saying it could go down to parity or at least the 103s if again the German elections don't come out favorable for the euro. So let's see what happens with that. Euro yen, a nice trade on this. Several of the guys in the group ended up taking this trade over the last couple of weeks, got in up here and taken some profit down here. So well done to those traders in the group. So yeah, the euro yen really should be a sell. The Bank of Japan are hiking rates, euro are cutting rates, and so yeah, this is basically what's happening, right? So if you are looking for a trade, then there is some hidden supply there. But outside of that, I think you would have to kind of wait for prices to move back up to the 160s before looking at going short. So no real reason to buy the euro against the yen over the medium to long term. Again, in the short term, you could see the euro start to rally a bit based on the German elections, but ultimately I think it still would mean that the European Central Bank are looking to cut more than the Bank of Japan, so you would still look for sell trades, or I would look for sell trades. Euro pound, again, we could see the euro start to rally based on short-term sentiment, but not really a pair that I'm interested in. But if it does come up to the 0.837 area, then I do think that that could be a decent sell. Technically, nice fresh area of supply. This is known as a capture pain relief trade. Traders are kind of trapped up here. They're captured in this area. I think we should add to the supply equation when prices come up here, or if prices come up here. So that would be an area that I would look for technically, but fundamentally, I do think that the pound does have the edge over the euro and in the short term. So that could be a trade you could look for if you're looking to buy the pound over the euro. If you're looking to buy the euro over the pound, then pretty much now is your option or your chance. And looking at the Aussie dollar, so the Aussie dollar pulled back a bit. It was due. And so with both currencies, I do like the Australian dollar from a fundamental perspective, but from a risk sentiment perspective, the Australian dollar, with tariffs and China, is a bit of a tricky one. So although I would probably buy the Australian dollar fundamentally, not necessarily against the US dollar, unless you're trading you're trying to trade the tariffs, and you believe that Donald Trump is going to be less aggressive on tariffs and deals are going to get done in the short term. So any pullbacks, you could look for buy trades if you are looking to buy the Australian dollar. Around there. If you are looking for a buy trade, but for me, I think the path of these resistance is still to the downside, buying the US dollar. On the balance of probabilities, I believe that Donald Trump is still going to continue to try to be a bit aggressive on those tariffs, and the US dollar should want to strengthen. Moving to gold, and gold continuing to make new highs, nearly at the 3,000 mark. And we see here that gold's appeal to central banks seen underpinning demand in 2025. So World Gold Council says uncertainty makes gold strategic asset. Central banks added over 1,000 metric tons last year. And geopolitical and economic uncertainty remains high in 2025, and it seems as likely as ever that central banks will once again turn to gold as a stable strategic asset, the industry association said Wednesday in its gold demand trends report. The outlook comes after the council highlighted an all-time high in annual demand last year as central banks continue to hoover up gold at an eye-watering pace. Gold jewelry was an outlier, with demand falling due to soaring prices. We expect central banks to stay in the driving seat and gold ETF investors to enjoy the fray. The report said jewelry demand will remain under pressure, and we may see further growth in recycling. Mine supply is expected to remain robust, and this is the global gold demand edges higher to record in 2024. So again, we're seeing more demand for gold, and central banks likely to continue buying due to the uncertainty. So for me, should really be probably more of a buy on pullbacks as long as the uncertainty continues. And then, or maybe down to if it comes down to the 2,750s, then looking for a potential buy trade around there. So part of these resistance should still be to the upside. I am cautious though, because the higher prices go without a pullback or a deeper pullback, the more when you get that kind of correction, the deeper it tends to be. So I'd be wary about buying gold around this area here. Probably more about the 2,752 area. And looking at the S&P, so the S&P sold off on Friday, and it was it says here stocks get hammered as traders hit risk off button And consumers' long run inflation views rise to highest since 1995. US business activity moderates as service sector cools. So it says here stocks had their worst session so far in 2025 after weaker than expected economic data and a surge in consumers' long run inflation views to the highest since 1995. From consumer sentiment to housing and services, Friday's reading unsettled investors at a time when the Federal Reserve is in no rush to cut rates. The S&P 500 lost over 1.5% and bonds rallied. A notional $2.7 trillion of options tied to equities and ETFs was set to expire. That usually amplifies price swings. Also contributing to the volatility was a rally that COVID-19 vaccine makers as traders shared early reports about a new coronavirus study in China. So, risk off coming into the market, various risk off events. And so, I think this is more likely just, again, a bit of a scare. We had that happen, in December 18th. There was some risk off event, then eventually the market recovered, right? Now, I'm not saying that the same thing is going to happen. Again, there's lots of commentary suggesting that the S&P is way too overvalued, but ultimately, a due a pullback. So just be mindful if you are looking for short trades. Of course, you can look for short trades, but I think ultimately the path of these resistance should really be to the upside and continue to be to the upside, even if prices pull back a bit. That would be my direction until something materially changes. But ultimately, the S&P in my book is a buy. So getting into the trade updates now. So that brings us to the end of the analysis, but getting into the trade updates. So Swiss yen from last week, this was a nice trade, ended up taking profits really down at these lows. I was planning on kind of holding the trade for a bit longer, but decided to take profits. So overall, this was a profitable trade. Let me go down to the hourly. So originally ended up getting into two trades, three positions. So when prices pulled back, I got in the market order, and then I managed to get into that position there, and then that position there, and then I took profit on that position at a 1-to-1. Was swing trading this one down as well. So that I think I took off at a 1-to-1. And then the final position ended up taking profits off somewhere around here, and that ended up being a nice 2.66 or 2, somewhere around there to 1. So ultimately this whole trade was a profitable trade. So very nice on the Swiss yen. Going forward, I will be looking for more bigger pullbacks to look for short trades as the Bank of Japan look to hike rates and the Swiss National Bank look to cut rates. So that's pretty much really the plan. So very nice trade on that. New Zealand yen. Unfortunately, this trade, I say unfortunately, this was a profitable trade, but it didn't go as planned for my final two positions. If you go back and watch last week's video, you'll see that prices were really up here and I'd been triggered into 4 positions. Now, as we, move to the to the beginning of the week, the higher position, which was here, right, managed to hit a 1-to-1. So as it came down, 1-to-1 was hit, lovely on the open, and then the second position, which was here, managed to hit a 1-to-1 a bit later. I think it was like the Tuesday, so that was there. So then I was only opening 2 positions, which I planned to swing trade and hold. So I had one of my positions, my targets for this one, for this position here, was there, which would have been about a 2.2-to-1, somewhere around there. And then I was looking to hold this trade, for the foreseeable future. But what ended up happening was I trailed my stop down. So remember, this is already a profitable trade because I took profit on 2 positions. And so as I started to trail my stop down, right, I trailed it to, I think it was here, and on those two positions. And then we had some good news for the for the trade anyway. So the inflation rate actually went higher than forecasted, or higher than the previous at least. And so in the short term, when news comes out positive for your trade, sometimes what can happen is that the market can do the opposite, right? So it basically starts to hunt for liquidity. If there's not enough orders, buy orders to facilitate the selling, yeah, because if new traders need to get involved in this sell trade, they need buy orders below the market. Then if there's no buy orders below the market to facilitate more selling, yeah, then basically they're going to look for buy orders above the market. And if anyone is going short, right, and selling, yeah, let's say for example you sold on the news, your stop loss is a buy order, right? Because you've pressed sell, and then when you get triggered, you're forced to buy back at a higher price, which is the reason why you lose, right? So all the liquidity was above the market, so it took out all of the stop losses, including my trailing stop, right? So it went above my trailing stop, and then eventually went to the downside, and then hit target on my one of my positions. So ultimately it wasn't necessarily a loss, because um, the trade was still profitable, but just not as profitable as I wanted it to be, because my entry was here, ended up getting 12 stop there, and then my entry for the fourth position, the market order, was there, and also got trailed out for basically a very small win, tiny win, pretty much a break-even trade. So two wins, small win, sorry, and then pretty much a near break-even trade on four of the positions. So overall, again, a profitable idea. The idea was good and sound. It's just sometimes you get trailed out on volatility and liquidity hunting, right? Nothing we can do about that. So those are the two trades that those are the two trade updates. So I'm no longer in the Swiss yen, and I'm no longer in the New Zealand yen. I'm flat on those. And new trades this week was the New Zealand dollar, US dollar. Managed to take this, and this was due to a daily supply zone. Prices came up to an area that I thought was quite nice, and then managed to get involved in this. So my entry was here. Stop loss was 15 pips above the high. Prices pulled back to this area here, which managed to get me into a second position, and that position was profitable. So as prices came down, that was a 1-to-1 right there. And so yeah, that ended up being hitting profits. So now I'm just looking to hold this trade hopefully down to somewhere around these lows. Now I've cancelled the two sell pending orders above the market, so I've taken the risk out of the trade. So if price does come all the way back up here and stop me out, then the worst that will happen is that this is a break-even trade. But as prices start to move to the downside, if they do, what I'll then do is start to just trail my stop further down behind it, and see if I can um, you know make the most of the trend, as well as locking in some profits at the same time. So yeah, at the moment that is at least a minimum of break-even trade, but profitable on paper. And then the final trade, the second trade this week that I took, was the dollar Swiss. Again, really kind of based on the higher time frame, well, based on really the fundamentals. But you've got a demand zone with right here, and so when prices came down into that demand zone, I managed to take a trade around here. Started the trade, and again, four positions, market order, and then three pending orders. Now I've been triggered into two pending orders as prices have pulled all the way back down to here. 1, 2. The final pending order hasn't been triggered. Prices came down, didn't trigger me into that trade. So let's see what happens with this. So still in this trade. No profit just yet, but if we do start to move a bit higher, right, I'm hoping that actually we get triggered into that trade first before we start to move higher, and then I can start to, you know, take some profits off and then see if I can hold it and see if prices can go to the upside. So yeah, that's where I am with the dollar Swiss. Anyways, guys, hope you all enjoyed the analysis. And again, just a quick reminder that on Tuesday you can get full access to the supply and demand course content and all the fundamental analysis, as well as the fundamental analysis spreadsheet, and all the analysis that I provide in the YouTube, but a whole lot more. So yeah, I look forward to working with you if you decide to join. If not, I do wish you all the best. Take care and speak to you all soon.